Ladies and gentlemen, thank you for making time to join us this Saturday evening in Nairobi. It's 5 p.m. and we are very excited to be able to be discussing markets over the weekend, courtesy of what's happening globally in as far as COVID is concerned. Welcome once again. My name is Mbithe Muema and I will be hosting this free webinar that has been brought to you courtesy of Abojani Investments and sponsored by Scope Markets. Today, we have a very special guest, Mr. Vitaliy Katsenelson. He is a US contrarian investor. He has published 2 books, the Little Book of Sideways Markets, as well as the book of Active Value Investing. And he has been looking at US stocks and trying to make a good return for his investments, as well as on behalf of the investors that he looks after their portfolio for a very long time now. Vitaliy is very contrarian in his thinking. He takes broad concepts and makes them very simple for new and for old investors, just to get a fresh breath of air in terms of what is happening in investments and what is driving investments. He has been out there speaking to a couple of investors as well as global platforms, so it's certainly a privilege to be able to have Vitaliy with us today. Welcome, Vitaliy.
Mbithe, it's my privilege. Thank you very much. Thank you.
Okay. So Vitaliy, perhaps we can just start with an overview of your books and your work, and what are the key things that separate you maybe from your common investor? What makes you stand out in your framework and your views of investment?
Well, if you talk about my books, I think what I did, and both books are very similar, actually. Let me just tell you a little bit about my books that do differentiate between them, because there is not that much difference, actually. So I wrote my first book, Active Value Investing, in 2007. And I think that book has 280 pages, 75 charts and tables. And it took me now a year and a half, maybe 2 years to write it. Huge amount of research. And it's it's basically written for people like me. Like it's for professional investors. And then my little book of Sideways Markets, basically a few years later, my publisher came to me and said, can you take your first book, simplify it, and write it as if you were writing for your neighborhood dentist, which is it's a very different type of writing. And I like the challenge. And so as an investor, I'm proud with my both books, because I think, it's basically the same concept, just, condensed. As a writer, I find my second book so much better, just because I was given a second chance to take something complex and distill it down to its essence. So both books basically describe a concept, what I call sideways markets. And basically it looks at the market, not in the short-term perspective, but in the long-term perspective, like but we're talking about 100 years. And then if you kind of zoom out and look at the market from very long-term perspective, you find that there are patterns that develop in the markets. You have this you have this bull market, last, 15, 18 years, and then you have a sideways market that goes up and down and it's not really going anywhere. And then the premise of my book was that in 2000, we entered into the sideways market. United States has. And the rationale for that was, the difference between market cycles, bull markets and sideways markets, was just basically the valuation. When the stocks are expensive, when the starting valuation is expensive, then as price to earnings declines, it basically eats away at the returns, of earnings growth. And that's why the market go nowhere. And that was the premise of the book. And I think for a long time, it seems, I was proven to be right. What has changed is that when I was writing those books, interest rates were at semi-normal levels. I never expected interest rates to decline to zero and to go to negative in some countries. And that has changed the dynamics of the markets in the short run. Basically, so that was kind of the macro view of my books. So the strategy we practice at my firm, and the strategy described in my book as active value investing, which is basically how do you invest in an environment where there is a constant pressure of price to earnings that's keep going down. and because that's what we experienced from like for half the century, you know, in the 20th century. And so and you know, and that, so that's kind of, so that's what basically the strategy I described in my book. There's the strategy we practiced at my firm, though I'll be honest, as an investor you have to continue to evolve. So I'm on the version 20.5 or 50th version of my strategy, because even at the core it remains the same. You continue to evolve and adapt because the environment around you changes. The environment today, even in May 16th today, for us, has changed so much if you compare it to what it was in April 16th or March 16th or even February 16th. Okay. So so I hopefully I summed it up.
Yes, you've summed it up, because what you're really saying is value investing it's paramount to whatever you're doing, but then it has to keep changing based on what is happening in the market. Yes. I also like that you bring in the name of your fund, IMA, and you are the Chief Investment Officer.
Yes.
Have your views on investment changed pre and post COVID?
Yes, tremendously. I wrote, like when the COVID just broke out, I wrote an article and I look at this article and I feel that I was so naive. Like I look at the article and I basically said, well, expect a recession. So take out the playbook of recession, and that's the playbook, for this environment. And now I look at this in a real, and as we've been living through this, we've been getting more and more new information. And I realized that the strategy today has to be so much different. It has to evolve tremendously because the world around us has changed. So yes, so it has, the strategy has to change, and we have just.
Okay. Did you sell out of any positions before the COVID started, or when the onset of COVID happened in your country? Did you sell out of positions?
Yeah. So when it was evident that we're gonna go through something similar what Italy was going through, like. You didn't know the magnitude, etc. But when it was evident that we have the virus on shore and it's going to be, it's going to spread, we went through our stocks and we basically sold anything that was close to be fairly valued. It wasn't quite, like we might have waited for another 3 or 5% or whatever, or 10%. We raised cash that way, and then throughout this environment, as we began to understand the impact it has on the economy and impact it has on companies, we have sold some companies. We have sold some stocks, but in March we have done a lot more. But then we've done a lot more buying than selling. Okay. So we've been adjusting our strategy, but we've been both selling and buying.
All right. So when you are looking at the portfolio of US stocks, and I want to imagine that's your investment universe, is that correct?
We invest in the US and Europe for the most part.
US and Europe. All right. When you're looking now after COVID, after things begin to quiet down on a health perspective, are you opportunistic about certain sectors, and what are the key triggers that are making you become opportunistic?
So today, if you look at our portfolio, 4 sectors basically are the core of it. It doesn't mean that that's all we own, but we kind of identify, we were looking basically for things that are not going to change. What is not going to change? And so we identified sectors like healthcare is not going to change. And I'm generalizing because maybe hospital healthcare will change, but the medicine consumption is not going to change, for instance. So healthcare in general is not going to change. The defense spending is not going to change, and I would argue today the world is more dangerous or less friendly than it was 3 months ago. So the defense spending is not going to change. If you had bad habits, those especially if they were addictive, they're probably not going to change. So we own a lot of tobacco stocks. Okay, and then finally, consumption of internet is not going to change. So we own telecommunication companies. There are other, this is kind of the broad strokes, and then we just kind of start going one stock at a time. But those are kind of the constants. So and I'll tell you, just before today, before like an hour ago, I went for a walk in the park, and I spent a lot of time thinking about it. Let me give you this data point. We own Comcast, which is a telecommunications company. They provide cable, broadband that I use to communicate, to talk to you right now. I read their transcript. They said that 95% of the customer service people work from home. 95%. And you know what they may discover after this is over, that maybe they don't need to have all these people drive an hour each way just to get to a big loud room so they can talk to clients, right? So now just let's take this further a little bit, right? So what happens if Comcast does this and a whole bunch of other companies do this? Well, suddenly the demand for commercial real estate in downtowns will decline tremendously. While also the demand for cars will decline because we may not drive as much. Also, we're going to use less oil. So the question becomes, does this habit, just one little thing, well, it's not that little, but that change, what ramification does it have on so many other things? Okay, some things will benefit from this, some things will not. So the sales of video, of the cameras or microphones I'm talking to will probably go up. Okay, but at the same time, consumption of oil may reset to a different level that we have not seen before. Okay, so this is just, I want you to think about this. If you and I talked a day ago, I would not have had this insight. After reading Comcast earnings call or to the presentation, that's the new insight I have. And so now suddenly my decisions will start evolving as well. So it's a world where I don't think I have changed my mind, and I have I have adjusted my mental models as fast ever in my life.
Okay, that's very interesting, because what you're really saying is, I don't think we have the luxury of being complacent in not understanding what's happening each and every single day. And maybe you can now walk us through what are the key tenets when it comes to value investing, because your books and some of the things that you bring out in your previous writings were aligned to the fact that yes, you are a long-term investor, but have short-term activity points. But from this example of Comcast, you're just bringing in a different perspective in terms of, how do I manage my portfolio today? What are 1, 2, 3 key things that I need to be constantly looking at, especially because of what has happened in light of COVID?
Okay, so let me just contrast two companies, okay? So let's say, and I'm generalizing, let's say you have a cable company, okay? And I would argue that their earnings will become, and cash flows will become higher over time, not lower, because of this, okay? Because people will need, if you work from home and you do a lot more video conferencing, etc., you need a bigger broadband pipe. So you'll be paying for higher service. Okay. So from value investing, so I basically, if you look at Comcast, I say, well, so the company just became more valuable because the cash flows will be larger, right? Again, I'm looking out not just for next 3 months, next 6 months. I'm looking out years and years out. And from that analysis, you see, okay, the cash flows are more valuable, and therefore the value of the company has changed, okay? Now, if you look at let's say, let's take the same analogy, let's say the same, the other side of the coin, and let's say you have an oil company, or let's say you have a car manufacturer. Let's say in the US, I think on average we sell about 17 million cars a year. If we drive fewer miles, we're gonna start selling maybe, I don't know, I'm just making this up, 15 million cars a year, okay? And let's say this is proportionate, in China it will be the same thing, in other countries will be the same thing, hypothetically. So suddenly car companies, their earnings power has declined, okay? So therefore, if you thought General Motors was worth $40, now you think, you know what? if I kind of apply this new data points I have for the long run, then maybe it's worth $30. So depending where, I don't even know where the stock is today, but if if the stock was at $25, you say, well, if it's worth 30, maybe it's not, maybe the return I'll get is not enough. Okay, so what it does, because the fair value has declined, the value of General Motors has declined, therefore you need a larger margin. And this is a very important point. What we don't know today, the outcomes, or what the future has such a wide outcomes. Okay, we have, and a lot of it will be dictated by things we can control. Will the virus come back in the fall? Will the virus go away in May or June? We don't know that. Will when the vaccine, are we going to have new drugs? When will vaccines come, etc.? All these different things we have no idea. We have no idea about. So therefore, for what's good about, like when you go to like companies I mentioned, like defense, telecom, etc., the range of outcomes for them is very, very narrow. Okay, the range of outcomes for an auto company or an airline or even oil stocks is becoming extremely wide. So in my thinking, I'm trying, if I am buying a company like General Motors, and again, I don't own the stock and I'm just picking them because that's the first company that came to my mind. I would want to have answers to two things. Can they survive? And this is important. And that, if the path ahead of us is very, very, very bad, unfavorable to them, can they survive that? Because when the companies revenues decline 30, 50, 70%, suddenly they start losing a lot of money. And some companies can sustain themselves for longer period than others, depending on the cost structure and how much debt they have. So that's the first question. Second question is, okay, even if they do, okay, and that that's kind of immediate, kind of intermediate path does not destroy their capital structure. In other words, they don't have to issue a lot of shares or don't have to issue a lot of debt, and suddenly they, etc. What will their worst case earnings power going to be after that? And so this is kind of the thinking I'm going through when I'm analyzing companies today. And what I found that most of our portfolio today is focused on the companies where I don't have to worry about the short term, where I don't have to worry about the companies surviving in the short term. I don't have to worry about the earnings power, difference between a kind of conservative and aggressive outcomes is very narrow. That's like, personally, this is where I want to be. Okay, it doesn't mean that's the right thing to do for everybody, but in the companies we're looking for, those are the kind of the qualities we're looking for.
Okay, fair enough. So you're really looking for quality, and quality for you today is sustainability of revenues, but more importantly, cash flows. I hope I've gotten that right.
That's right. Yes.
Okay.
But let me, if I could just interrupt them, there was one point I want to make. So the quality, what quality means has and has not changed. Okay. We own a company that we sold, that we analyzed, we stressed their business, how it looked, how it went through the 2008 financial crisis. And we realized, okay, even if you have this very bad recession, even worse than financial crisis, they should be okay. So their business will make less money, but recession lasts quarters, not years. And they'll get through this, and it's just going to be a negative blip. Today, and that for us, that was a quality business. Today, when we look at this, and this company was in the aerospace, like they made parts that go into airplanes, and they also made parts that went into cars. Today we look at them and we say, well, we're not sure that they're going to survive, because if 95% of planes are grounded, and when the travel comes back, it's going to come back to a fraction where it was before. It means you won't have to, the demand for planes will be, so much smaller. Okay. So anyway, so we used to think that's a quality company. It's not a quality company anymore for us. Anyway, So I'm sorry to interrupt you. Go ahead.
No. I mean, I think you really preempted my question, because I wanted to just ask you in terms of looking at growth, valuation, and quality, which are key things that you speak about in your previous frameworks. Has that changed? But maybe just to come to the tail end of that question before I get into the question and answer session from our audience, and yes, please feel free to put your questions up, is on valuation. What is valuation looking like? Where are you seeing value? And I know we discussed this before we started the call, and you said your focus is European markets and US markets. Do you ever look at emerging markets? And what would your sentiment be on valuation, especially on equities? Then we can touch on alternative assets after this.
Okay. So I find I consider myself Westerner, and like culturally Americans and Europeans have a very similar culture. So I can understand. Like, to me, it's easier to analyze European companies than American companies. You know, also for me to buy into a company, it has to operate in an environment where there is a very little political uncertainty, where there is a rule of law. And so a lot of times emerging market countries don't have that. So if you invest in them, you really have to be focused on it. It doesn't mean you shouldn't be investing in them. That's not what I'm saying. What I'm saying is, you really have to understand them. You need, and you have to understand geopolitics there as well. So I never invested in African companies.
Okay.
I've been to South Africa. I've been to the continent twice. I've been to South Africa twice, and I guess that's my first virtual visit to Kenya.
No,
but
fair enough.
But the point I'm trying to make is that when we analyze just think about this. What valuation is this: the value of any asset is the present value of its future cash flows. Okay, you just figure out what the future cash flows are, and then you use some kind of discount rate and figure out what the company is worth, and then you say, well, if the company is worth $100, really, there's no point of me paying $100 for that, right? Because so you want to buy at the discount to that. Okay, and depending on company's quality, the risk that $100, then you're gonna need higher discount, lower discount. That's it. That's all the valuation is, really. So now, if I'm looking in a African company, hypothetically, I need to be certain. I really need to be certain that what the value is, and that value can be interrupted if suddenly there is a regime change and suddenly the government nationalized the company, for instance, nationalized the company, right? So anyway, yeah.
Fair enough. Maybe let me ask it differently. So your sense of valuation in your investment universe, are you now looking at previous level PE ratios or relative valuations as a proxy, or are you discounting further because of what has happened to COVID? So what's a good entry level, just basically looking at equities based on your experience and the universe that you are looking at?
Yeah, no, I think that's a great question, right? I think there are two questions buried into it. So first of all, the one that you really asked was about what price to earnings, how much do you want to pay for those earnings, okay? And I would argue that I talk a lot about that in this book. So there's a relative valuation analysis and absolute valuation. Relative valuation is say, well, this company used to trade at 25 times earnings, now it's at 20. In relation to 25, 20 seems to be cheap. Well, the thing is, the past, and especially when you had a very low interest rate environment and when the valuations is high, may not necessarily a good guide to what the future valuation is going to be, okay? So therefore, what we try to do absolute valuation analysis. In other words, say, let's look forward. What are the cash flows? And then discount it back, and let's figure out how much we want to pay for the company based on this. That's point number one. But point number two that was buried in your question is this. I think it's very dangerous to look at 2019 earnings for all companies and assume that's the earnings power of those companies, okay? Because for some companies, it will be, for some of them will maybe even higher, but for a lot of them, it won't be, okay? And so just like what you and I talk about General Motors, or if you talk about oil stocks, right, all the companies, if the virus, there was it seems like what happened last couple months, it accelerated trends that were already in place. So what you may discover that the earnings power for a lot of companies that, for some companies has permanently changed. So you have to mindfully go through this and say, okay, this is what they make 2019, it's irrelevant. Let's get a blank piece of paper and look at the company, let's figure out, is demand really 17 million cars or it's less? Yeah, it's in case of General Motors. But anyway, so.
Okay, I think that's a very good summary, because it's really the same case even looking at investments in Africa and emerging markets, because really what you're saying, valuation is important, but at this case, prior period valuations and earnings drivers could or could not have changed depending on the industry. So you're saying there's need for a little bit of work to be done just to reevaluate if the drivers for the company earnings still remain the same or have changed.
Yeah, so let me just, I know we got to go to Q&A, but so in physics, there is a concept called first principles. So it's basically when you look at a problem as if you do nothing about it. So you start with a blank piece of paper and you start solving this problem, and I think we need to start approaching investing kind of more from a first principles perspective, saying if you know nothing about the past, how does the future look?
Okay, I like that. So if you know nothing about the past, how does the future look?
Yeah.
Okay, fantastic. I think maybe I have one or two more questions on equities, and I think for the audience, the forum is open. Please place your questions on the question and answer section, and we'll get into that in maybe 2 or 3 minutes from here on. The other question I wanted to ask, when you're looking at different asset classes, I know you look at gold, you probably look at commodities and metals and equities, and I know your focus is really European and US asset-based or investment universe. Do you have a sense of what particular class will outperform the other, at least over the next 12, 18, 24 to 36 months?
It's a very good question. You almost have to separate like industrial commodities from gold, because the industrial commodities, we use it to build things that move things around, right? Or or construct structures. Gold, really, most of the demand is not for the industrial use. It's really, most of it is just, think about most of the gold we get out of the ground and we put it in the bank. That's it. It has really like very little practical use, except we think it's money. So let's start with gold. My thinking in gold is kind of has evolved over time. Gold is basically a story. Okay, just like, and this is a bigger answer that, probably can take more than 3 minutes to answer this. But so if you think about gold, think about money in general. When you were very little, your parents took you to the store and you bought milk. And what you observed, your parents taking the money out of the wallet, given to the clerk, and you realize this paper buys milk. Okay, this is a story that you observed millions of times over your lifetime, and you say, this is money. So money is a story. Okay, this is a story that we accept. Everybody accepts. So what happens is this. But what happened over the last 2 months, and I'm talking about just right now, just by the United States. Okay, our government basically, they were forced to create $5 or $6 trillion of money. Okay, so that means, in theory, what it should mean that the money should be worth. So we just created a lot more money. Okay, and so the gold. If you look, and by the way, our Federal Reserve is buying $1 trillion worth of bonds. All these things basically should undermine people trust in the paper money. Okay, so and that's how you get inflation. Okay, so if you look at gold, one of its properties is that it's very difficult to create it. The central bank or government cannot just create gold, okay, out of nowhere. It's a very laborious process to get out of the ground. So think about it for a second. The gold is also a story. Okay, it's not as well accepted story as paper money, because some people believe it. Some people believe in it, but not all of us. So, but as you start seeing around you, like, you know, the central banks globally creating money out of thin air, you start thinking, well, maybe that's going to be storage of value over time. So I'm not I would rather own a company that has earnings power and that can raise its earnings over time. But today, if you own gold, you have a certain percent of portfolio in gold, it's a kind of a rational decision. But my only caveat there is it has to be a position in the portfolio. It probably should not be the portfolio. In other words,
Okay.
If you have a few percentage of your portfolio in gold, whatever that percentage is for you, that's fine. But it should not be the portfolio. It should not be just gold bars, buried under your mattress kind of thing. About other metals, it really comes down to supply and demand. Okay, if this puts us into if this virus puts us in a global recession, then demand for all commodities will decline. So we just don't know exactly. Well, by the way, we're already in a recession, but it's really, it's very difficult for me. The reason we don't own many commodity companies is because the price and profitability of companies is set by two forces aligning: supply and demand. Yes. And it's very difficult for me to predict either one of them. This is why I try to focus on things that I can predict.
Okay, fair enough. I like that you brought out the stimulus package and what's happening in the United States of America. So what impact would this have on the S&P companies? Do we expect a rally in light of maybe weaker fundamentals, or what are your expectations on how the market could trend maybe over the next 1 to 3 years?
Well, so it's kind of interesting. It's like now you have in the S&P, you have haves and have-nots. The haves are the ones that are basically virtual companies, like companies that whose products is virtual, the Googles, the Facebook. Think about it. There's one caveat there. Their products are virtual products. They're not really impacted by physicality. They're not as impacted, at least at first, by physicality, what's happening outside, right? And what happened was, if you look at the top 5 companies, they today comprise like 21% of S&P 500. Let me clarify this. The S&P 500 index is constructed, but you basically take companies by its market capitalization. If you take top 5 companies, they are basically 21% of the whole index. Okay. In other words, the 495 companies, the rest are 80%. Okay.
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 Wow.
So anyway, so if you look at it's kind of funny. The index is not down as much. I think the index overall is probably where we were in September 2019.
Yes.
Okay. But today we have, first of all, the global growth is going to be much lower than it was in the past. The global economy has a lot more debt, and the earnings power of S&P 500 is probably going to be low. We know it's going to be lower going forward for at least this year and next year. So to me, like if I was buying the whole index, I would be very concerned. Okay. So the good thing about us, and this is, is that we are not buying the index. We are buying individual companies. And if we are buying individual companies, and if you look at, and our companies are trading at a fraction, at a much smaller valuation than the index. So I have no idea what the index is what the market is going to do.
Okay. So it's more selective. Okay.
Yeah.
Let me follow it up with a second part to this question, Vitaliy. So what are good stocks that you're seeing of value now that COVID has happened and we're getting to a semblance of certainty in terms of the way forward? And what would be indicative entry levels? I don't know if you can help us maybe answer that. And I'm coming from the context of we're in Africa, maybe we don't pay too much attention to what's happening in US, and someone is beginning to look at the United States and saying, I would like to be invested in the S&P 500. Where would I start? What would be good companies in your professional opinion? Not to say that it's investment guidance, but where would you tell us to look for value, and what would be a good entry level for value?
All right. Let me try to answer this question by not answering, but I'm going to do it this way. So
okay.
First of all, no, but I think this is more important than what I would. The answer. What I'm about to tell is more important than. So I think if you're listening to this, you should never listen to people like me and I say buy stock XYZ. Never do this. And here's why. I might change my mind tomorrow. Like, because remember how I told you, like how just I walked in the park today and my thoughts have changed? I might change my mind tomorrow, right? And with the stock that I like today, I might sell it tomorrow. Okay. And if you have bought it just based on what I told you, what I like today, you are doing yourself a lot of huge disservice. First of all, you missed the opportunity to learn, okay? Because really, when you do research, this is when you learn, okay? Second of all, I gave, you only got half of a decision to buy. You never got the other part of the decision when to sell. So also, even let's say I buy the stock today and a lot of bad things happen. I may buy more, I may do nothing, I may sell, but you will not know that. So what I suggest anybody, like this applies to anytime you hear somebody talk about stocks in the public forum, this is just should always be the beginning of your journey, never the end. So okay. I talk to a lot of other value investors like me, and we share ideas, and somebody mentions the stock, and to me, this is just the beginning of my journey where I start doing my research. So in broad sense, today, we like as I mentioned, like 4 industries, kind of tobacco, yes. Defense, healthcare, okay. Telecom. So maybe that's a place for, for whoever listens to this to start. But again, investing is such an individual journey just because, and there's another element to this. I buy a company, when I own a company and I understand the business very well, when the company goes through a roller coaster, if I understand the business, what it's worth, I'll sleep well at night. It's not going to bother me. Like when you and I talked about commodity companies, like my understanding of commodity businesses it's just not very good, and my EQ, my emotional state is going to be very volatile. My personal emotional state will be very volatile if I own a commodity stock. Therefore, that's why we don't own commodity stocks, because I know is that I lack on both departments, understanding the business and my emotional quotient, my emotional state will be very volatile. That's why I don't own it. If you we like cigarette companies, and I feel fairly comfortable, my emotional state when I own cigarettes is fine. Some people, but it may or may not be for you, right? So therefore, you should also, this is why you should, when you analyze company, you should ask yourself a question: am I going to be able to maintain my rationality when things go bad? And if you can't say yes, then probably this may not be a stock for you to own.
Okay, I think that's a fair answer. Maybe the follow-on question on that would be the technical parameters, just looking at what's happening in terms of price movements up and down, and looking at US today vis-a-vis what's happening with COVID and the lag effect once the health pandemic is resolved. Would that be a good space to look at? And what would you advise people to look at if they're using the technical parameters as a metric of screening some of the stocks that are listed in the S&P 500?
Well, what do you mean by that? When you say technical parameters, what do you mean by that?
Price movements. So there's some stocks that have come off, there's some stocks that have gained. So when you're going into these stocks and you're screening, you're saying, okay, fine, I have looked at the fundamentals. Maybe I'm looking at the aviation, rather the defense industry or the health industry or whatever industry I feel is doing well. Then the next point is maybe I want to look at the price movements. Is that still something that's viable today in your view? Would it be something that you'd advise someone who's starting out to look out for?
We do look at price movements in a very superficial sense. If something declined a lot, we'll just kind of say, okay, so there's a huge, think about it as this, there was a huge garbage bin with stocks that declined a lot, and we kind of go through this and say, was it thrown away for the right reasons or not? So we kind of, I do look at this, but just as a kind of as a very initial screen for possible ideas, but that's just one of the screens, right?
Okay. All right. So what are the other screens? Maybe you can briefly just walk us through.
Well, so then you start thinking qualitatively, okay, what is not going to change? Like
Okay.
when you and so and you start saying, okay, well, and then helps you to kind of identify industries, and then you start looking at these industries. Um, we own this company that is the largest seller of RVs, recreational vehicles, like campers. Okay, and ironically, because people now we are coming to towards summer, and Americans need to go somewhere with the kids, and they've been stuck in the house for 2 months. Okay, you can't really fly anywhere. You can't really go to Disney World. You can't go to Miami or Florida, whatever. So because you don't want to get on the plane, so the menu of things you can do has shrunk tremendously, right? Because most of the things involve the airport. And so one of the things on the menu now is camping. And so ironically, this is a company that in any other recession, it would be pummeled. It's going to do phenomenally well because people are going to be buying campers. So this is like, how does that, that's not going to show up in any of your screens, but anyway, so, but
All
that's
right, fair enough. Okay, maybe my final question, I think, on the equities. What then would be a good source of just somebody who's looking at U.S. markets getting acquainted with information, broadly speaking, alongside looking at your books and looking at the frameworks?
So, like you're talking about websites, which websites you would go to?
Yes. Are there websites? Are there spaces that consolidate information on U.S. equities and performance, and a space where people can get a sense of what's happening and what to expect?
So I'm the worst person to ask because we use a lot of because we use a lot of institutional tools that are not available, but I will start with I'll start with Wall Street Journal to read American news about American companies, what's going on in the United States. I would probably read Yahoo Finance has a lot of financial data on U.S. companies. Those would be I'm not sure I'm a great source for that.
It's okay, I understand, because I know typically institutions would use Bloomberg to get as much information, but I'm seeing somebody here also contributing and saying Yahoo Finance. I think there's a while I used to look at Motley Fool. I don't know if that's still a resource or if you've looked at it.
It's just not like one of many. It's another.
It's one of many. All right. Sure. Okay, and then do you have a sense of maybe the overall valuation for U.S. stocks? Are they trading at a high price to equity ratio currently? What's the dividend yield on average? Is that a figure that you?
I don't have it. But I know that. I know. So let me put it this way: the stocks today are extremely expensive in general. So remember when I said S&P 500 is not a great, like the indices to me today are overvalued. So yes. I'm not a big fan of the market today.
Okay, so they're overvalued. Does that mean you expect a correction?
I expect basically markets going sideways. In fact, it's kind of funny. My book is more relevant now than it was any time over the last 10 years. So I think just because I think
All right. So I think for anyone who's trying to understand that market, we must first start by reading your book, and the books that you have written are The Active Value Investor and the Little Book of Sideways Markets. Yes. So we're still taking questions, and Vitaliy is here to answer most of the questions. I think for the audience, let's just try and focus on as much information we can get in terms of the frameworks for investing and getting a better understanding of the US markets. I've seen a couple of questions looking at Kenya and what is happening in Kenya, but I think that will be a separate session going forward. So as I'm waiting for more questions, there is
I should ask you questions what's going on in Kenya. Not,
I'll respond to that maybe later on, just to be able to share. Actually, maybe that's something I'll be able to answer when we finish, just to compare the notes in terms of what you have shared. Allow me to just go to the question and answer section. So we have a question here on, is there any implication of US elections on US equity markets over the next 12 months?
That is a great question. And what's interesting is that to some degree, the difference between Republicans and Democrats has kind of disappeared to some degrees, because the Republicans used to stand for small government, and and lower taxes. They stuck with lower taxes, but the government got bigger because the amount of, even under Trump, before the coronavirus, the amount of debt we had has skyrocketed, has went up. And now the difference between Republicans and Democrats even got smaller, in the sense that the amount of debt we have issued, we basically have created over the last 2 months, has been tremendous. And I think that might have been the right thing to do. So I'm not criticizing that. I think I look at it today and I really don't know. To be honest, I really don't know. This is not me trying to say who I want to be elected. That's not the case. I'm not sure who is better for, if Trump is elected, if this is going to be good for if it's going to be good for the economy and global stability, or vice versa. I just don't know. So I don't know what the market will think. So
okay.
So I don't have a good answer for that.
All right, but maybe I guess maybe I might be crossing a line here, but I want to imagine that the person asking this question is just trying to get a sense of, do the equity markets in the U.S. correct downwards because of U.S. elections? Is that a key risk factor, or are we past the worst in terms of looking at these equities?
Oh, I mean, markets can decline more. I mean, there is no reason why they can't.
Yeah.
So I don't know what the markets will do. I really don't. And I try not to forecast that. And I think in today's environment, and this point is very important. The reason when you own a company whose survival is path dependent, and this is a very important concept. If you own a company that, I'll give you an example. If you own an airline, and this recession lasts, let's say, a year, a lot of airlines, and the people, people don't fly for a year, the airlines will still exist. It's just the ownership will change, right? So as an equity investor, we get wiped out. Now, if this is over tomorrow, and people, if we have vaccine tomorrow, whatever, market disappears the virus disappears tomorrow, the airlines will be, great investment. I choose not to own companies that are path dependent, that depend on how long the virus will last, because I want to sleep well at night. And therefore, I can maintain long-term time horizon. So when I own companies, so when you're a stock market investor, you really want to be a long-term investor. You want to be looking not just next 6 months, but years and years out. And to do this, you really need, want to own companies that are not path dependent. And at least that's the choice I made in our portfolios.
Okay, fantastic. I think we have another question, and somebody's asking what your sense of the oil markets are, because we did hit a negative figure, I think a month ago, and yesterday we topped $33 per barrel. What does this mean for the global economy? Yeah, no, so it's kind of interesting. So we own one oil stock, so we have a little bit of exposure to oil markets. And our rationale for this is very simple. When oil prices are very low, it basically destroys supply, because a lot of companies go out of business, and so supply declines. And when the demand comes back, then the prices go up. It's kind of a normal capital cycles. Kind of so in other words, low prices cause high prices. It's one of those truisms when it comes to kind of commodity industries. However, what bothers me about what I just told you is that what will the demand be? So just think about this. It's very simple. So we basically globally, we produce and consume in, let's say 2019, about 100 million barrels a day. Okay. Today, I think our consumption declined to 70 million barrels. And OPEC, I think they cut the production by, I forget, 10 or 20 million barrels a day. So there's still so when the economy kind of comes back, the question is, what level will it come back to? Okay, remember the example I gave you. If we
become a lot more virtual globally, if we stop driving to work as much, does that mean that the normal consumption of oil is now 90 million barrels a day? Just think about it, right? And so suddenly, the production has to be, a lot lower, 90 million barrels for the prices to kind of stabilize at higher level. Once I realized that, I became a lot less bullish on oils than I was maybe even a week ago. So
I guess there's just too many moving parts. So your head has to be in the game literally every day.
So if you listen, it's kind of interesting. Warren Buffett had an annual meeting. And by the way, if you are watching this, you should, after this, you should watch Warren Buffett annual meeting, which I'm sure you can find on YouTube. And if you watch them, you will see a person who says, "I don't know a lot."
Yes.
And I think that is extremely important. So if I say I don't know a lot because I really don't, I don't want to project false confidence where I really don't have an answer. Okay. And it's more important to have a model and thinking model than just to have an answer, because as you get more information, you can put more inputs into the model and get to an answer than just to say oil buy or oil sell. So I
hear you. No, I hear you, and I completely empathize with you. It's really more or less a similar situation even for us. I think I look at Africa and I look at emerging markets. So it's a similar situation where the focus, and I really like what your book brings out, is you have to have a framework and you have to have the discipline so that you're able to manage the volatility and not necessarily make emotional decisions. I think there's somebody here who's asking a question in line with that and asking, I'm from a developing country and I would like to get exposure to US and European stocks. Are there ETFs or are there platforms that you would probably refer the person to if they wanted to get exposure to some of these equity opportunities?
I'm the last person to ask about ETF because I don't own any ETFs. So
okay.
I'm sure there are. So if you go to Morningstar's website or Motley Fool or Seeking Alpha, they probably and spend a few hours on this, you can find a whole bunch of ETFs there. I'm not the right person to answer the question.
Okay, but I think there's a lot of value. What I'm getting from you is just going through the way you have defined the content of managing your behavior and getting the discipline to investing in different markets. And perhaps on that, I'll probably ask another question of, what are the 6 commandments of value investing that you define and articulate in your books? Maybe that can help people who are getting into this space.
So that's great. I think that's great. And so I'm working on my 3rd book. Okay.
Oh, wow. Maybe you can tell us what's going on there.
So this is where the 6 commandments are coming from. So what happened was this. So as I mentioned, the first book I wrote for my competitors. The second book I wrote it for kind of your neighborhood dentist, or kind of, let's say, my prospective clients. And this book I'm writing for the audience of one, me. Okay. This is really my journey of becoming a better investor, because it's a journey, because you're never a destination. You're always trying to improve. You're always trying to get better. And this is my way of, instead of telling people I want to become, by me becoming a better investor, writing this book, I hope I become a better investor. That's all it is. So there is no publishing deadline. There is no even a publisher, because I don't even care if it's get published or not. So this is a book I'm writing for me. But the very first chapter, basically, I'm laying out fundamental principles of value investing. But if you listen to podcasts, if you go to a podcast, what we did, we actually put the chapter on our podcast, which is on investor.fm, investor.fm, or if you go to our website, which is contrarianedge.com, you can sign up and we'll just send you the chapter. So there is no strings attached, etc. So the 6 commandments of value investing, I'll try to remember all of them right now, but basically this is kind of the principles that I took out of the Intelligent Investor, book by the grandfather of value investing. So the Ben Graham. And I tried to kind of say, well, this is how we took these principles and this is how we apply them. Okay, that's what the chapter is about. So the 6 commandments are basically, number 1, you treat businesses not as a pieces of paper, but as businesses. So when you look at the stock market it's so easy to look at that as a just kind of a more like a casino. You can look at Microsoft, you say, oh, yesterday it was 120, today is 130, it's probably going to 150. Okay, so now Microsoft to you is really just like a chip if you go to a casino. Like it's just really, it becomes a like roulette table. And that's what stock market does to you. However, Microsoft, the way a value investor would look at Microsoft, look at it as a business. If you are buying a private company, how would you be analyzing it, right? Because if you buy a private company, you can't just flip it tomorrow, right? You don't have that instant liquidity. So therefore, your analysis of Microsoft would be very different if you were buying the whole company, okay? So it was not just a piece of paper. Then you start looking at so another commandment would be, when you buy a business, you want to have a margin of safety. So if, because, bad things will happen. Okay, so when you're analyzing a company, you make certain assumptions, and then other things will happen, and suddenly you want to make sure that you bought cheap enough that if bad things happen, you won't lose money. Some of my investments I'm proud of is where I did the analysis, and some things happened that came out of left field, and at the end, when we sell it, we just break even, or whatever, or don't lose money, or make a little bit of money. But the reason I'm proud of this because we bought it cheap enough. We bought it cheap enough that when bad things happen, we don't lose money. So that's margin of safety. Another commandment is the risk is not volatility, but permanent loss of capital. Listen, the stock prices go up and down a lot every single day. And if you look at that as your risk, you're in the wrong business. Really the true risk for us, because the thing about the stock price is just an opinion of somebody on the stock that day, right? When you've done all this research, why do you even care what they think about it? Okay, so the true risk is that permanent loss of capital, where the value of the company has declined. Like, well, let's say, like if you own the airline stocks, the risk to you is that they issue a lot of equity, and suddenly you have to you have to split the future earnings with a lot more shareholders. That would result in permanent loss of capital, or if it goes bankrupt, that is the risk to you. Okay, how about this? There's 3 other commandments, and why don't they just read it or listen to it on the investor.fm or Contrarian Edge? How's that?
I like the way you're lighting up when you're finally talking about your upcoming baby in your book. I'm very excited about it. So let me ask you that, and I'm still taking questions and answers. So Vitaliy, what has been the most amount of money you have lost in an investment, and what happened?
Well, the dollar amount is irrelevant because it's just how much money you mentioned at the time. We lost 50. There was a few investments over my career that we lost 50-70%.
Wow.
And it's I try not, so what you try to do when this happens, you try to see if this was a failure of your system or it was just bad luck. So this, when something like this happens to you, that's actually it's a very good thing, because what it does, it keeps you overconfidence in line. It kind of keeps you in check, and so I'm trying to think with a lot of times. So every single time it happened, it made me a better investor, and I'm trying to think, and every single time it improved our systems.
Okay. So are you making those mistakes less now that you have come up with different frameworks and you're keeping on adjusting the investment process?
Absolutely. I made a lot fewer of those mistakes. Like but you know what the interesting part is this, and this may sound bad. The biggest mistakes I made was not on losing money, but on selling too soon. Like, I'll give you an example. So just think about it. The most I can lose when I sell, when I lose money is 100%, right? Mm-hmm. I'll give you one. So we used to own a company called Electronic Arts, which made EA, which makes video games. And I forget, I think we bought it like at $16 or $17. It declined to $13. We bought more, then it went to 10. We didn't buy more. Then it's doubled. It went up like to, I don't know, to $28 to $30, and we sold it. And it's kind of, the ownership was kind of, and I celebrated it. I danced, I celebrated this. Oh, great, we doubled the money. Today it's a $120 stock.
Wow.
Just think about this, right? So my loss was really 300%, right? Because we sold it too soon. And what I learned, and so to me, that was a very educational lesson, actually. And that was because what happened was, when we owned it, I was contrarian. At the time when we owned it, there was a lot of bad news. They had it's like, think about it, the video game company is almost like a movie studio. You come out with movies or games, and you're gonna have a blockbuster, so you're gonna have flops. Well, to make long story short, they had a few flops, okay? And so we owned it for a long period of time. Every single day the stock would decline, and every single day, decline itself didn't worry me. Every single day new news would come out, another game failed or something, they created a game on Star Wars at the time, which lost them $500 million. Just the development of the game was $500 million. They lost that. Anyway, so that made them better. And so when we saw, the reason I was, when the stock doubled, we sold it, and I was celebrating this. And I was so happy to get rid of this, because I'm like, okay, we doubled the money, let's close this chapter, move on. But the lesson was actually this: when you have a company where your thesis is still intact, where you think the earnings power is still there, and it has bad news, this is the time you want to zoom out a little bit, and kind of walk away from watching it, and kind of to pay close attention to kind of daily fundamentals, because what it does, it exhausts you. Okay, and if I did this, I probably would have held on to it for much, much longer. And so the loss to me was, probably a much bigger loss than the company that I lost 50% on. Okay, wow. Because the return would have been, 300% more. So instead of being, just think about this. I'll give an example. So at 5% position, it doubled. So we made 5% from the total portfolio. We could have made 25%. It could have become whatever. It could have become 20%, 20, it went from 5% position to becoming 25% position. So that was one of the bigger mistakes I made. And there are plenty of others like this. So experience is just collection of bad judgments, right? And then you just try to learn from them and get better. So I'm making fewer mistakes now. I'm just making different mistakes.
All right. So in summary then, when would you say is a good time to sell out of an asset? What's the absolute maybe 1, 2, 3 things that would give you a sense of, okay, now this is a good time to sell?
So there are 3 reasons why you want to sell a stock. Number 1, it kind of reached your fair value, and we'll come back to that one. Number 2, something has changed. Something has changed, and you go through your assumptions, initial assumptions, you realize those assumptions are no longer valid. So it's not necessarily that you made a mistake, or you might have made a mistake, but it's just the facts have changed since you bought it. So that's another reason to sell. And the third reason to sell is let's say you own this company, and the return, it's return 5% a year, and you can find something else that has a higher return. So that would be another reason to sell. But let's come back to the first one, and that's I'm going to zoom in on electronic arts. Certain companies, you want to be patient with selling than others. Like electronic arts, because it has such a huge tailwind of video gaming behind it. I should have had much longer leash, kind of like, when you walk a dog, you have a short leash and you have a long, kind of expandable leash. When you own companies that have a huge growth tailwind behind them, you want to have a longer leash, and you want to sell in smaller increments. When you own companies that are kind of not growing very much, you want to be more discreet with your selling. So that's the one of the lessons I learned.
Oh, fantastic. So we still have the question and answers going on. Let me look out and see what's happening here. So there's somebody who's asking if you might talk about how to think about position sizing when structuring a portfolio, especially when there's a sudden market move, such as what we saw in March. How would you go about readjusting the portfolio to recover from any losses that you might have incurred during the period?
So position sizing in general, the way we approach position sizing, let's say you have, like I'm going to give you a couple criteria. So you say you have high quality company, you have low quality company. So everything else being constant, high quality company should be a larger position, low quality company should be lower position. Now, let's say you have another company on a different dimension, cheap company, expensive company. Cheap company should be higher position size, expensive company have a lower position size. Now, let's marry these two dimensions. Now you have a high quality company that is cheap, should be much higher position size. And you have expensive company, low quality company that's expensive, it should be lower position size. So we literally go through, in our process, we go through every company, figure out what the fair value is, and that based on today's price, we figure out its cheapness. And then we also, for every company, we actually go through the systematic ratings, A, B, C, and D, and assign a quality to each company. And based on that, we figure out the how much, so that gives us the quality rating. And then we marry quality and cheapness, and that's how we come up with the position sizing. Also during, so what we did during during like in March, when the market was melting down, I came up with this new term called microdosing. Like usually microdosing has a negative connotation because it relates to doing some kind of drugs and microdoses. But I figured, I'll bring that mental model to value investing.
Okay. Fair enough.
So what we did, we basically bought smaller positions because we had to do research. Things were moving so fast. We had to do research on the fly. And we realized I worked long hours as is, but I realized even when you're doing research so fast, we'll make mistakes. Some companies that we already looked at for a long time, it was easier to make, we would make larger position decision. But the ones that were somewhat new to us, and we spent less time than we normally would, we would just buy smaller positions, like microdosing. So we ended up buying like a lot of 1 or 2 or 3% positions, instead of buying 3 or 5% positions, So.
All right. Thanks for that. Then there's another question that is looking at investing in bonds today or U.S. treasuries, given what's happening with the stimulus and the deficit. Do you have a view on this particular asset class?
Yeah, so if you're buying U.S. treasuries, and when I say this, you basically buy short-term treasuries, you're not really investing. You're just basically parking your money because it's not going to pay you anything. So it's not really investing. It's really just parking your money. I think buying long-term bonds may prove to be risky because we just created all this money and we may have an inflation, huge inflation. And you guys are in Africa, so you're used to inflations. We kind of haven't seen one in a long time, but they do happen. They do happen. So I would stay away from any bonds that have a duration, like they mature more than a year out or 2 years out, something like that, because you're getting very little return and you're taking a lot of risk. So bonds to me today are just like, if you want to own U.S. treasuries just as a place to kind of, the U.S. cannot go out of, U.S. as a country cannot go bankrupt. Not because we're such a great country, just because we can print more money. And we kind of still reserve currency for now. And so therefore, U.S. treasuries are the safest place to be in the short run, not necessarily safe place to be in the long run because we're going to have inflation and their buying power will get eroded. If we have inflation, the buying power will be eroded.
Okay, fantastic. And maybe in line with that, and this is bias, do you look at currency as a parameter to your macro evaluation when you're investing? Are you looking at the
yeah, no,
dollar?
it's a good question. Usually I'm kind of ambivalent. Like currencies are very difficult. It's like almost like looking at commodities and stuff. So I just like when I invest internationally, I just want to make sure currency does not hurt me. And I always look at currency as a risk. And therefore, since my clients spend most of their money in dollars, the foreign currency to us going up is not a risk. It's going down is a risk, really, right?
Okay.
So I try to limit our exposure to to a certain currency. So I want to make sure that not all my portfolio is in euros or in Swiss francs or whatever. But today US dollar was so strong that I think probably have exposure to non-US dollar assets is probably in a kind of developed countries is not such a bad idea.
Okay, fair enough. Thank you for that. Then we have another question here. Which fundamentals matter the most to you? And does this change depending on the age of the company? When you're doing your fundamentals research, whether it's revenue, whether it's free cash flow, whether it's costs, and does it matter with age?
Yeah, because I was puzzled by this question because I don't even think about it this way. See,
how do you then think about it?
Yeah, no, I just like everything, like why.
Okay, Vitaliy, hold on. Let me ask it differently. Let me just forget what you know. So you said we're on first principles. So today I come and tell you I'm from Kenya. There's a great company called Safaricom. It has revolutionized mobile banking in ways beyond our greatest imagination. And then I tell you its current price is X. It's trading at, I think, multiples of about 20 times earnings, if I'm not wrong, give or take. And it has a 4% dividend yield. And I think it has a lot of growth opportunities. The last reported numbers, the earnings were up 14.5%. And it has been growing in double digit. And, its capital expenditure is more or less known. I mean, it sounds like an interesting opportunity. How would you walk me through just broadly, how would you then start looking at this company to decide whether you put money in it or not?
So what we would do, we would look fast forward to 4 years out. Okay. So we don't stop today. We look 4 years out and say, what do we think the earnings power of this company? When I say earnings power, it's a very kind of a vague term because to us, it basically could mean different things. It could mean free cash flows. It could mean also what would the earnings be if the company was not growing. It could mean different things. But it's basically companies. So if it's a high growth company, let's say let's say somewhat capital intensive company.
Yes, it's telecom. It's look at it like the way you're looking at Comcast, only that it lays fiber and it sells us internet access, what we're using. It sells us mobile money, and it also sells us airtime and voice.
Okay. So the mobile money probably is not very capital intensive, right? Because that's that's just a virtual business, basically. It's a fixed cost virtual business where the, laying fiber is so like if I was looking at that, whenever you look at a company that's actually truly capital intensive, one of the things you want to see is like, what is actually return on the assets, right? Is that actually, like when it lays fiber, is that a good investment or not, right? Okay, but then you also want to say, okay, well, what return on investment once it reaches certain utilization, okay? Because think about it, when you lay fiber and there's 10 houses in the neighborhood and it only signs up one house, the return on investment will be horrible. But then every single incremental house that it signs up comes at almost zero cost, right? Because it's already, okay, so basically, the way I would be analyzing it, if you kind of, again, this is not a public company, if you own the business, okay, is that a good business to invest in? Okay, so I'll be looking, like in this case, I would be mentally going through, okay, does this company have a good return on capital? So this fiber decisions, okay, they actually.
So you would be going through maybe the annual statements and any public information to understand. All right, okay.
That's right. And then I would kind of, one thing we do, we always lay companies kind of, we look at what what the business looks 4 years out. And the reason we do this is actually very unique to us. I want to own companies that if a company is not growing, it has to have a much greater discount than if a company is growing. So in other words, if company is not growing earnings, right, then when I look at it 4 years out and then figure out what it's worth and then discount it back, then it will be penalized for this non-growth, right? So versus when a company is growing earnings, let's say 10% a year, and I discount it back, actually time is on my side because its earnings power has increased and therefore the business became more valuable, okay? So, and then I would, so in case of that company, I would be looking and say, what are the earnings 4 years out? Okay, if they, if they are kind of in a steady state growth, if they're not expanding, or maybe in this case, I would even go further than that. And then I would try to figure out, so assuming I want to be in this business, assuming they have a return, good return on capital, they have good balance sheet.
What's a good return on invested capital in your view?
It depends. It has to do with the cost of capital, but it's probably a rule of thumb. If you get 15%, that's okay. A good return on capital. So it's again, if this in their money business, if it's all virtual, then there is no there is no return on capital it's almost irrelevant, right? Because the cost of the capital base there is very small, so it becomes infinite. But anyway, so I'd be going through this kind of analysis, and then I would be also looking at the management. Okay, do they own a lot of the stock? Are they good capital allocators? How well they run the business? What is the culture of the company? So it gets, it's not a. Here's the thing: investing, there is an art element to it, and the reason there is an art element to it because you can't put it into formula. You can't just put it into this, this in the formula that has an answer. I was born in Russia, and there was a movie in Russia called Formula of Love, and I watched it when I was a kid, but there was a guy who was trying to find formula of love. Well, it's kind of the same thing. Like there's no really, there's no formula for of love. So there's no formula for investing either. So, so I would be just basically that's what would be going through my head, and then if I as a U.S. investor looking into Kenya, etc., in Africa, I would be started looking at the political risks, kind of how stable is the government, etc. So we're looking at a company in the Brazil right now, and I really like everything I hear about the company, except I'm kind of questioning Brazil. This is just coming from the place of ignorance because I don't know Brazil as well. But I start to study how stable is the political system there now, and so that's an additional step. Yeah.
Would relative and peer valuations have any place to play?
Yes, it would kind of raise questions like, okay, so if competitors are trading at lower or higher price to earnings, why? Like, I would want to know why. Okay, is there something what's the market what's market thinking about it? Because I may get some value out of this. Maybe the other competitors are stronger than they are, etc. So just another data point. That's all.
Okay, fair enough. Let me just quickly go through the questions and see what else is there. There's somebody who's asking what segments make sense, and I think I'll just reiterate what you said earlier. And there was technology, there was defense, and there was healthcare. Is there?
Yeah, healthcare and tobacco. Yeah, tobacco. Yeah.
And tobacco. All right. What about FMCG? Do you have a sense of what's going to happen there?
What's FM? I don't know what FMCG is.
Oh, sorry. I'm talking to you in Kenyanese. Fast-moving consumer goods.
Fast-moving consumer goods.
Beers, supermarkets.
Oh, so it's kind of funny. So like, what's fast-moving? Like it's a. For us, for us, it's a slow-moving consumer goods.
Really?
Are they fast-moving? No, are they fast-moving because there is demand, or because they have short shelf life?
Short shelf life, as well as a lot of demand for it. Very high demand.
Yeah. So now it's slow-moving consumer goods.
Okay.
Well, remember, this is developed market. So, like, if I was in emerging markets and it's a fast-moving consumer goods, those would be more interesting to me, especially if they are high-quality brands.
Okay.
Those would be more interesting to me because these things usually persist. In the US or developed markets, since they are kind of slow-moving consumer goods, I need to have a much bigger discount for them. So, because they already matured. Okay, they used to be fast-moving, they're now slow-moving. Therefore, if you are in the US and you're a company like Coke, right? Well, it's not a great example, but let's say you are Coke Butler in Africa, right? For you, it's a fast-growing market because, huge growth runway. If you're Coke Butler in the United States, there isn't any now, but if there was one, then it's probably it's a slow-moving consumer good. So therefore, it's very stable but not growing. Therefore, I would need bigger discount.
Okay, fair enough. I have one other question here that asks, how do you fish for opportunities in the ocean of global stocks? I know it's a very broad question, but
how do I wish for opportunities?
How do you find opportunities in the vast ocean of global stocks? So where do you decide you'll find value?
So you know what it is? So there are many ways. Number one,
yes,
I am lucky because I wrote books. Like I have a lot of friends in investing. Like I have a lot of friends in the community. So I talk to investors globally all the time. So this is why I get exposure to opportunities in other countries. Also, we do screens and we look for stocks, and so that's another way how we find stocks. And then finally, we look at an American company and we say, we kind of like this business. Let's see if they have competitors or similar companies in other countries. And that's the third way how we find basically in the ocean of global opportunities.
Well, here's another question. Is the time of recession a good time to start looking for value opportunities in equities? Is that a good time?
Yes. Listen, I had a client who emailed me, said, Vitaliy, don't you want to buy stocks when there is certainty about how this, and then in the next sentence, he says, you know what, I wish I bought stocks in March 2018. I mean, 2008, March 2008. So he just, and I told him, listen, just think about what you just said. On the one side, you said, you want me to buy stocks when there is certainty. Okay. Another side, you say, well, if you bought stocks in March 2008, you would have made a lot of money. Well, the thing is, in March 2008, when the market would just decline 50% or whatever that number was, there was anything but certainty then, right? In fact, you were buying, things were so bad outside, but that's why opportunities were there, because there was a lot of uncertainty. So certainty usually means high prices, uncertainty means low prices. So today, what makes it tricky is because the economy is morphing into something else while this is happening. Okay, the virus is kind of morphing the economy. So what makes my job more challenging today is that I want to buy value, but I want to make sure that whatever the earnings that I'm buying have not morphed into lower earnings in the long run. Okay, so this is why there's plenty of opportunities today, despite the market being expensive. But at the same time, you have to have this kind of first principle approach to investing and be aware that the virus is changing, it's kind of morphing our economy, and therefore in your approach you have to be adjusting for that. So yes, when you get certainty, everything is going to be expensive again.
Okay, fair enough. So there's the markets that we have operated in and the markets as we have known them, but now we are slowly getting into a global adjustments where markets will change differently in one way or the other, depending on the segments that you're looking at. Is there any advice that you'd be telling investors? These are some of the things that you must bear in mind, even as you're adjusting either your models or your frameworks or your way of thought when you're looking at investments?
Got it. Okay. So just I'm going to clarify the question a little. So when I say markets, usually means stock markets, but you also could mean economies. So,
Yes.
So, okay. So, all right. So I'm going to try to sum up.
Okay.
Like this, so they may be a little bit repetitive because that's, but to sum up, number one, you want to be very careful at looking at 2019 earnings power of companies and realize for some companies, this earnings power will be less, some of them going to be the same, some of them will be higher, okay? But unlike another recession where you go into recession, you come out and you can look in the past and you say, okay, well, before this company earned this much, in a normal environment, they're going to earn this again. This may or may not happen. Okay, so that's number one. Number two, and so therefore you want to use a first principles approach, as I described. Assume you know nothing and say, okay, what would this company's earnings power going to be? I think those are probably the most important things you can, like you want to make sure that the company is not path dependent, because we all want this virus to be over. We want it, like we wish it to be gone. We wish to come back to normal. But just because we want it to happen doesn't mean it's going to happen, right? So I wish for the best and I invest as if it's going to be around for much longer, right? And therefore the companies I own, they need to be able to survive the longer, more painful journey. So that's another thing. So you want to make sure that the companies are not path dependent, and so they have good balance sheets, all that.
Yeah. All right, fair enough. I think we're probably coming to the tail end of our question and answer session. Right. So I'll give our audience, please, if you have any questions that you would like us to address to Vitaliy, please feel free to put them up. I think we've tried to answer all the questions, but really what's coming out very strongly from this is there's a bit of work that we must do at an individual level. First, get acquainted with the existing frameworks and then keep abreast of what's happening globally so that you can own the decisions that you make. Vitaliy, as we await maybe one or two more round of questions, maybe I can ask you, as we're coming to the tail end of this segment, so what are you telling your investors to do today? Are you telling them, hold your money, give me more money, sell out of stocks? What are you advising the majority of your investors?
So my investors, I always tell them, give me more money. No, I'm not. No, so what I basically tell, I tell our investors to be patient. I'll tell our investors that we are building a portfolio for the long run. And I tell our investors that the kind of overall the markets are fairly expensive, but we don't own the markets. We own individual companies that are trading at a fraction of what the market's valuations. What I'm going to tell your listeners and viewers, it's really, there is no there's an expression which I really like, there is no shortcut to greatness. And the same applies to investing. Like looking, if you want to become good at this, you really have to work hard and learn a lot and read a lot. There is no, you want to kind of, the only way to become better at this is just by doing your own homework. And I know it sounds very banal and stuff, but that's really the reality of it. That's the only way you'll become, I wrote this article that you can find on my website. I called the letter to the young investors. And I was writing it as if I was writing for me 23 years ago, when I just got into the business. And there I go through the advice I would give my younger self. So if you go to my website, contrarianedge.com, read that article. It's there, and hopefully it will help you. Because so anytime I have a student reach out to me and say, what should I do? I say, just read this article. I wrote
fantastic. All right. And so I don't know if this is public information. How big is your portfolio, and what has been the average return, say, for the last 2-3 years?
Well, we can't talk about, I'm not going to talk
Okay.
about returns, but we managed about $130 million.
Okay, fair enough. So I think I have another question here, and it's very broad. Maybe you can be able to answer us. Somebody's asking you to talk about Uber. Maybe the person can elaborate what they want to know about Uber.
Oh yeah, I know why they ask. I know if they ask
Okay.
me about this, because I just wrote a literally 17-page paper.
Oh, fantastic. Please
Yeah.
walk us through it.
Well, so the number one, you can, so I keep, like, I'm so much better when I'm on paper because I have 17 pages to kind of lay out my thesis. So I would encourage you, just go to Control and Edge. It's right there. And
Okay.
you'll get it in the bite-sized increments by email. But but Uber is basically, the whole point about Uber is that when people look at it, they see a company that's losing a lot of money, and it has. And they see, and there are so many negative articles been written about Uber because this was kind of a symbol of venture capital malinvestment, where them and their competitors were throwing so much money at them that basically the venture capitalists subsidized Uber. When you took a ride to the airport, the venture capitalists paid for that because they kept the prices, they artificially low to get you, to finance that ride. Long story short, like in 2019, when WeWork blew up, venture capital markets normally kind of became more rational, and they realized that, and so the Uber and its competitors became rational, and Uber was on a way to actually break even in 2020. In this article, I basically walk you through my analytical framework, how we look at Uber, how we look at the market size, how we look at the optionality that's embedded in the company. And I would encourage you guys to read it, just because.
Okay.
And by the way, you can listen to it. We put it. They have a recording of the article. So some people
we'll read it. We hear you. There's no shortcut to what we're doing.
Yeah,
here,
I know, but it was, but also. Yeah, no,
yes.
but I just like, because it's very difficult for me to summarize 17 pages in a few minutes. But there's a lot of different frameworks. And the point I'm trying to make is you can also listen to it, like, because we just literally took the article, and I have a narrator reading to the article on investor.fm.
All right.
And the name of the
so
article
is it a buy, Vitaliy, at the current price based on your evaluation?
So I'm not gonna say. So I'm gonna say it. We own the stock, and say it's a significant position for us. Is that a buy? You guys decide. So
okay, fair enough.
But, but at the same time, I might sell it tomorrow, and who knows?
Okay, all right, fair enough. So I think maybe we're more or less done, at least with the questions for Vitaliy. Let me just quickly see if there's anything else there. All right, I think part of the facilitation team has already put up a website to view your articles and as well as listen to your podcast.
Yeah.
So if there are no more questions, perhaps Vitaliy, you can maybe leave us with some closing remarks.
Well, this is so exciting. I never really, like, this is my first virtual visit to Africa that's not South Africa, to Kenya, and this is very exciting, and I'm so glad you guys are really interested in investing and value investing. And it's a very rewarding experience, not just financially, but also intellectually rewarding experience. But as I mentioned before, it requires you to do a lot of reading, a lot of research. And whenever you listen to people like me, just listen, look for frameworks, okay? No, don't look for, listen, I analyzed Uber and I may end up being wrong, okay? But when you read the article, I lay out a lot of different frameworks there that you may be able to use when you analyze another company, and I think that's where the value is. So and thank you so much. You are such a wonderful host, and this is a great moderator. I can see why you are very successful on TV. So you made this experience very very pleasurable. Thank you.
Thank you so much, Vitaliy. That's very kind of you. And I think on behalf of of Abojani. Abojani offers financial literacy resources to the investing public in Kenya. And Scope Markets offers trading platforms for equities, both locally and globally, as well as commodities. I know I've seen very many questions on how to trade US markets, what are good platforms to be able to get into. I think it'll be worthwhile for our audience or for anybody who's interested just to look at Scope Markets or to be able to reach out to the team at Abojani to understand what's happening. And I think from my end, I think I've been looking at the markets. I focus on African emerging markets, trying to understand the trends and being able to call out investment opportunities. I also host a show called Markets Today, and I also on the side facilitate portfolio construction for people who are looking to enhance their value. So certainly, Vitaliy, it's been a great pleasure. I think as I mentioned earlier before the call, I interacted with you this week courtesy of Robert. And my first reading was the little book of cyber markets. I read it overnight. It really just compresses what I have been doing for the last 15 years and gives it such a simple framework to be able to understand investing. It's a book that I would certainly recommend to everybody, and I'm certainly happy to have met you and for the fact that you put in the time and work to put your thoughts on paper to share them with all of us. So on behalf of the investing community here in Kenya, thank you so much. We normally say asante sana for your time, and we hope to see you again, as Robert said, in a physical midst sometime soon. We wish you all the best, and we look forward to learning more from you. Thank you very much.
It's been a pleasure. Thank you. Thank you.
All right. And I think also to our audience, I wish we were in a place where I would clap for you. Your questions have been very good, and thank you for your patience as well. I recommend, please get this book and read it if you're new to the investment universe. If you have been in the investment universe for a long time, it's quite a refresher. So thank you so much. And thank you once again to Robert and the team at Abojani and Lawrence from the team at Scope Markets. And to everybody, enjoy the rest of your weekend and God bless.